Hello, how are you? This is Keith Singer of Singer Wealth, and we want to talk today about taxes. Now, obviously, a lot of our clients want us to help them make smart choices about their investments, which we're happy to do, but we also try to help them pay as little tax as possible. And I can tell you, in 25 years of working with families, I've never had one family say to me, Keith, can you arrange my affairs so that when I'm gone, as much as possible goes to the government and as little as possible goes to my family? And the reality is we're all entitled to pay as little tax as possible, and we all should pay as little tax as we're legally required to pay. However, if you don't arrange your affairs correctly, you might pay a lot more tax than you would otherwise pay if you made smart choices regarding your tax planning. Now, one of the things that a lot of people have that we meet with is a retirement account, an IRA, a 401k, a 403b. And when you can originally made that first contribution and contributed over the years to an IRA or to an employer-sponsored retirement account, that seemed like a smart thing to do at the time. You received an upfront tax deduction and you got lifetime tax deferral until you reached the age when distributions became mandatory until you took the money out on your own. However, even required minimum distributions were not so big that you would be unable to pass a large IRA to your children, who could then historically defer taxes for their lifetime, taking out only small amounts each year, and continue that tax deferral process for many, many, many years. Now, when the government gave you that upfront tax deduction, it was not a no strings attached tax deduction. It was only a conditional tax deduction. The condition is that you're going to pay Uncle Sam back by paying taxes whenever you or your heirs take out the money. Unfortunately, the government gets to decide how much you're going to owe in the year that you take your money out or your heirs take your money out, because they can change the tax rates every year. Imagine taking out a loan where the lender will tell you the interest will be determined on the day that you pay it back. You might be skeptical. You might be skeptical about a loan like that. Now, here's a little secret. The government has recently changed the rules on IRA distribution, which will increase the likelihood that IRAs will get taxed at the highest possible rate. Now, here's what I mean. The Secure Act of 2017 changed the game in a couple ways. One minor change is that the starting date from RMDs gets pushed back to age 72. Now, isn't that nice of the IRS to allow you to defer another couple of years? That sounds favorable until you realize that tax brackets are scheduled to increase back to their rates that they were before this last tax reduction in 2026. This means that everyone with significant RMDs will be paying higher taxes on those distributions. However, the major change was that your heirs can no longer take the money out over their lifetime when they inherit it. They have to take it all out within 10 years. That is a huge game changer. And when you have to take the money out over a short period of time, what does that mean? You're more likely to be in a much higher tax bracket, because just from the income alone from the IRAs could put you into the highest possible tax bracket. Now, most Americans have been conditioned to believe that they're going to be in a lower tax bracket when they retire. This may or may not be true depending on the declared rate at that time. However, what may be more relevant is under the new IRA, under the new rules, what tax bracket will your heirs be in, right? Are they going to be in their highest earning years for your kids? Are they going to be in states where they have to pay state income taxes that we don't have to pay here? Okay, so nobody really knows. But if you look at our national debt, it is increasing pretty rapidly, and we do need more money as a country to pay that debt. So logic dictates that taxes could easily be increased in the future. Right now, they're relatively low, and we know for a fact that they are going up. So here's the thing. We have to dissolve our partnership with the IRS one way or another. They're currently your silent partner. They don't tell you how to invest, but they tell you how much you owe them when you take money out and when you take out required minimum distributions as well. So you have two choices if you have a retirement account. You can continue to follow antiquated logic and keep deferring, potentially maximizing how much tax you're going to owe. Or you can be strategic and over the next several years, partially convert some of your IRA to a Roth IRA each year, pay a little bit of tax now and never pay tax again, because Roths grow tax-free, and it doesn't matter how much tax rates are at that time, you will not have to pay taxes out of your Roth. Now, won't I owe taxes if I convert to a Roth? You might be asking yourself, yeah, you're going to owe taxes right now in a year. The notion of voluntarily paying taxes is antithetical to many people, right? They just don't want to pay until they have to. I mean, think about when you pay your taxes when they're due on April 15th. You don't send them in on January 1st. You wait till the last day to pay your taxes, even though you're not making any money in the bank anyway. That's just how we're wired. But the question is, do you want to pay tax as late as possible? The question is, do you want to pay tax as little as possible? And to pay it early can reduce your overall tax bill. Consider this. Let's say we're going to convert 500,000 a year. So 100,000 a year for the next 5 years. A lot of people that we're talking to can do that and still be in the 22% bracket, maybe the 24% bracket. So if you take 100,000 and convert it and you pay 22,000 in a year, and then do that for the next 5 years, you're going to have $500,000 in a Roth, and you would have paid 110,000 of tax. So let's say at the end of 10 years, let's say you were 70 when you did your conversion or when you started your conversion, and now you have it doubled. Let's say your 500,000 doubled to $1 million. Okay, and that can happen over 10 years and you make 7.2% per year. And then you pass away, and your kids get that money, and they have to take it out after 10 years. And so now that million goes to $2 million, and now they have to take all the money out. How much tax they owe? Nothing. Okay, you already paid the tax. But if you don't do this, and your kids inherit the same $2 million IRA, and they have to pay taxes, they could be in the 40% bracket easily between what they have to take out of the IRA and what they make from work. They could easily be in the 40% bracket. And if they live in a state that has state income tax, they could be in a 50% bracket. And if rates went up, they could be in a 60% bracket. Who knows? So they could pay 800,000, $1 million, $1.2 million in taxes, or you could pay 110,000. The choice is yours. Now, there is a window of opportunity. For most people, you have to decide how much to convert each year. There's several factors to consider. What's the size of your IRA? What's the projected income that you're going to have this year and the following years? What's the projected income of your beneficiaries? What state do they live in? What's your marital status? What's their marital status? You need to consult with your financial advisor or your tax advisor. If you don't know who to talk to, you can call us. Call our firm at 561-998-9985 and just say you want to talk to one of our advisors regarding reducing taxes on your IRA. So I hope this was informative. Anyway, thank you for listening, and we'll talk to you soon.